Instead of waiting for the right time or the perfect plan, the key is to start immediately and adjust along the way. Many people waste time trying to plan every detail, which
Let's go,
often
let's
leads to
go.
procrastination. The best approach is to take action first and fix mistakes later. Success is never a straight path. There will always be obstacles, setbacks, and failures. But the only way to truly fail is to stop taking action. The solution to any problem is more action. If something does not work, it is necessary to try again, try differently, and try harder. Committing fully is the most important factor. Most people only give partial effort because they are afraid of failing or looking bad. But playing it safe guarantees that nothing extraordinary will happen. True commitment means eliminating all escape routes and refusing to accept anything less than success. It
Let's
requires
do a
working longer
continuation today.
hours, putting in more effort, and refusing to make excuses. Those who succeed are the ones who do not stop when things get tough. They push through no matter how difficult it gets. One of the most important lessons is to never reduce the goal, only increase the effort. When people struggle to achieve their targets, they often lower their expectations to match their current level of effort. This is a mistake. Instead of lowering the target, it is necessary to raise the amount of work being done. By consistently taking more action, anything is possible. Fear is one of the biggest barriers to success. Most people let fear control their decisions, which leads to hesitation and inaction. Fear should be seen as a sign to act, not a reason to stop. The best way to eliminate fear is through constant movement. The more action that is taken, the less fear there is. Fear only grows when there is hesitation. When action is taken quickly and consistently, fear disappears. One of the biggest mistakes people make is assuming that success is limited to certain people. The truth is, success is available to anyone who is willing to put in the work. There is no secret formula or hidden advantage. The only thing that separates successful people from unsuccessful ones is the level of action they take. Those who take massive action, work harder than anyone else, and refuse to quit are the ones who achieve the greatest results. Taking control of time is essential. Most people waste time on distractions, unnecessary tasks, or things that do not move them closer to their goals. To succeed, every minute must be used effectively. Instead of focusing on time management, the focus should be on productivity. The more work that is done in a shorter period, the faster success will come. This means eliminating activities that do not contribute to the goal and doubling down on what actually matters. The final lesson is to never stop. Once success starts to happen, many people slow down or become complacent. This is the biggest mistake possible. Success is not something that is achieved once and then maintained easily. It requires constant effort, continuous improvement, and relentless action. The moment action is reduced, progress starts to fade. Those who achieve true success are the ones who never stop pushing forward, no matter how much they have already accomplished.
All right, we've got a market open. Let's see.
If you're someone who stares at the trading screen with a storm in your chest and silence in your strategy, this audiobook is for you. Before we begin, don't forget to like, share, and subscribe to the channel for more powerful
Hmm,
audiobook summaries on trading and mindset mastery. Now, imagine this. It's not your strategy,
the one to use now.
indicators, or your analysis that's failing you. It's your mind. In the mental game of trading, Jared Tendler doesn't teach you how to pick a winning stock. He teaches you how to master yourself. This book isn't a motivational pep talk. It's a practical roadmap. With real tools, real routines, and a system grounded in performance psychology, it'll teach you how to control greed, conquer fear, and trade with clarity. Get ready to dive deep into the battlefield of the mind, where your true edge begins. Chapter 1: A System to Fix Mental Game Problems. Every trader, at some point, experiences mistakes that feel impossible to explain. You might know your strategy well. You might have clear rules and strong analysis, but still, in the heat of the moment, you click when you shouldn't. You hesitate when it's time to act. You double down after a loss or exit early from a winning trade. This is not a technical issue. This is a mental problem that needs a structured solution. The lesson here is simple. Trading mistakes are often emotional in nature. They're not random, and they're not signs that you're broken. They're signs that something deeper is going on in your mind. To solve this, a system is needed. Not a set of shallow tricks or surface level fixes, but a solid structure that digs into why these problems happen and helps you fix them at the source. The solution is not about suppressing emotions or pretending to be a robot. Emotions are natural. In fact, they're useful. But when they overpower your decision making, they must be managed with understanding and control. The process begins by looking at the problems with clarity, not judgment. You're not weak or flawed because you make emotional mistakes.
That's
You're
alright.
human.
I'm
And
gonna
if you want
wait
to grow as a
for the
trader,
first 5 minutes
you
to
must take
close.
responsibility for solving
I'll
them.
use the meet
The first step
for the
is
rest.
learning how to recognize when a mental problem is happening. You must catch it as it starts.
It's
It
regular
means
trading
becoming
hours
more
now. We
aware
have
of
a
how
good
your
chat.
emotions build during trading. Maybe you feel a tightness in your chest before you take a risky trade. Maybe you notice your heart beating faster after a big loss. These are signs. If you pay attention to them, you'll start to see patterns. The next step is to understand that these reactions have a cause. They don't just come out of nowhere. They are learned behaviors, often connected to past experiences, habits, or beliefs that have been built over time. These problems can be solved the same way they were created, through repetition and training. You must learn to respond differently. That means practicing awareness, thinking clearly under pressure,
Are
and
we
using the
looking to
tools that help your mind return to a calm, focused state. When you feel fear or
flip
greed, you don't just push it down. You investigate it. You find out where it comes from. You break the pattern by understanding it. Over time,
35
your
and
brain builds new responses. You train yourself to stay in control even when things are moving fast. One of the most important lessons is this: mental game issues don't go away by avoiding them. You must face them directly and treat them as real problems that need structured solutions. It's not about just feeling better, it's about performing better. And that means building your mind the same way you build your strategy, with precision, patience, and daily work. When you do that, your emotions no longer control your trades. You do. Chapter 2: Map your problem. Before you can fix a problem, you must see it clearly, and that's where everything begins. The first step is learning how to build a detailed map of
it's
your main mistakes. This
big
map
tune
is like a personal
important
tracking
for that.
system. It
I
shows
was
you how
feeling
your
price
mind
is gonna
works
go
when you
close up
start to
this
lose control. To make this work, you need to catch the moments when your mental
okay.
game breaks down and study the
This
whole
phone
chart. You're not just looking for emotions like greed or fear. You're trying to understand what causes them, when they appear, what thoughts come up, how your body reacts, and what actions you take afterward. To do this well, you have to look closely at your trading sessions. When something goes wrong, don't just move on. Write it down. What time did it happen? What was happening in the market? What were you thinking just before and during the mistake? What physical signs did you feel, like tension in your neck, faster breathing, or heat in your face? These details are clues. They help you spot the pattern. Maybe you hesitate every time price moves too fast, or maybe you get overconfident after two wins in a row. The goal is to find the signs before the problem gets worse. Once you start collecting this information, you'll begin to see a pattern in your thoughts, emotions, and actions. That pattern becomes your map. This map helps you find
looking
out when
for
a
the
problem
main point,
starts,
but it's
what
not
triggers it,
that's
and
all.
how fast it grows. For example, if you keep breaking your rules after a big win, you'll see that the feeling of being unstoppable is your first warning sign. That's when you need to pause, reset, and avoid going down the same path again. You're also taught how to separate the stages of the problem. There's the trigger, the thing that starts it. Then there's the rising action, where your emotions begin to build.
This week.
Next comes the tipping point, the moment when you lose control. After that, the problem explodes and you make poor decisions. Finally, there's the aftermath, when you feel regret or confusion and wonder why you acted that way. Learning to spot each of these steps gives you a clear structure. It helps you interrupt the pattern early, before it reaches full strength. It's important to understand that building this map is not something you do once. It's a process. Every time you make a mistake, you have a new chance to update the map. As your awareness grows, the map becomes more accurate. The more accurate it is, the better you can prepare for those moments when your mental game is tested. You don't need to be perfect. You need to be aware. That awareness gives you the power to step in at the right moment and stop the mistake before it happens.
Yes, man.
This map becomes your personal guide.
You could
It
run this
shows you how
higher
your
as well
mind
before
works when
going
things
down.
go wrong and helps you stay in control. Over time, it becomes one of your strongest tools, not just for trading, but for everything. Chapter 3. Identify the root of your problem. Before you can fix your mistakes in trading, you must understand why they happen. Most traders keep fixing the surface. They try new strategies, change time frames, follow new people online, but they ignore what's really going on underneath. You might think you have a discipline problem or that you're just emotional, but those are not the real issues. They're just symptoms. To solve them, you need to look deeper at what's happening inside your mind at the root level. Every mistake you make is caused by something you've learned over time. Maybe it came from past trading experiences, maybe from childhood, or even from how you learned to deal with success and failure. These learned responses live in your unconscious mind, and they control how you think, feel, and act, even if you don't notice them. If you don't go deep and fix the roots, the same problems will keep coming back, no matter how many new plans you try. To find the real cause, you need to start tracking your trading mistakes carefully. When you make an error, write it down. What happened before it? What were you thinking? What were you feeling? What was the trigger? Over time, you'll notice a pattern. Maybe you get anxious when your trade goes slightly against you. Maybe you feel the need to win quickly. Maybe you keep doubting your system. These are not random moments. They come from something deeper. And to fix them, you have to go there. There's a learning model that explains how you grow as a trader. At first, you are unconscious and incompetent. You don't know what you don't know. Then you become conscious of your mistakes. This is where most traders start improving. But to truly level up, you need to reach the point where correct actions become automatic. That's called unconscious competence. The problem is most traders never fix the errors deep enough to get there. They stay stuck in a loop, always fixing the same things over and over. Here's how to move forward. First, keep doing your emotional maps. Track the situations where you slip. Don't just look at one trade. Look at many trades over time. Then, ask the hard questions. Why do I react this way? Where did this feeling come from? Why do I hate to lose so much? What am I afraid will happen if I'm wrong? When you ask these questions seriously and reflect with honesty, answers start to come out. Sometimes, you'll find that your trading mistake is just the surface. Maybe you always close trades early because deep down you fear loss, not just in trading, but in life. Maybe you chase trades because you're used to proving yourself quickly, like you had to do growing up. These are real roots, and once you see them, you can start to change. Now, once you've found a root cause, write it down clearly. Understand it well. Then, come up with a correction, a statement that challenges that belief. For example, if you think, I have to be right all the time, your correction might be mistakes are part of learning. Perfection is not required. This new belief must be used again and again until it becomes natural. This work takes time. You won't solve every root problem in one day. But if you stay consistent and keep digging deeper, your trading improves from the inside out. You start to make fewer mistakes, not because you're forcing yourself to behave, but because the reason behind the mistake is gone. Finally, remember this: your worst trading habits are not personal flaws, they are learned patterns, and that means they can be unlearned. You just need to be willing to look deep enough and fix what's truly broken. Not the charts, not the market, but the programming inside your own mind. Once that happens, real growth begins. Chapter 4. Greed. Greed is one of the most dangerous forces in trading. It makes traders break their own rules, chase profits that aren't really there, and hold on to trades long after the smart move would have been to exit. But greed is not just about wanting more money. It shows up in many ways, like entering trades too early, adding too much size, taking trades outside your plan, or staying in trades even when the signals say to get out. What's really happening is that something inside pushes you to ignore logic. This force often grows when you feel like you're behind or missing out. To understand how greed works, it's important to look at the moments when it shows up. You may have just come off a losing streak, or maybe you're close to hitting a profit target for the week.
Whatever, man.
You might even see
Whatever.
another trader online posting huge wins,
Whatever.
and suddenly your own plan doesn't feel exciting enough. These moments create pressure. You
Whatever.
want to catch up, you want to feel better, and that's when greed strikes hardest. The mind starts to imagine big wins and fast money, and your discipline starts to slip. At the surface, greed seems like it's all about money, but that's rarely the full story. The real reason behind greedy behavior often comes from deeper mental patterns. Some people chase money because they think success proves their self worth. Others get greedy when they're bored,
And you would have come
stressed,
back to knock
or
my break
frustrated in
even
life.
after
The
going
problem
down.
is not the feeling of greed itself. The real danger is what you do when you feel it. The most effective way to handle greed is to build a map of how it shows up in your trading. Start by writing down what happens before, during, and after greedy trades. You might notice that you feel more excited than usual when a setup appears. Or maybe you start thinking about how much money you could make rather than focusing on the quality of the setup. These signs are clues that greed is taking over. When you study them carefully, you'll start to see a pattern. Once the pattern becomes clear, it's time to look for the cause. Ask yourself why you got greedy. Were you trying to make up for earlier losses? Were you feeling pressure to prove something? Maybe you were afraid of missing out. The deeper reason gives you the key to fixing the problem. If you discover that you get greedy when you're behind, then the real issue is probably your relationship with losses. You may see losing as failure instead of part of the process. That mindset needs to change, or else greed will keep showing up again and again. Another key idea is that you must adjust your goals. When the goal becomes to make money fast instead of follow my edge, your judgment weakens. Focusing on executing well rather than making money helps reduce the emotional fuel that feeds greed. You can also use a mental reminder before each session to stay focused on process, not outcome. Something like, I follow my plan. The market does not owe me anything. Repeating this with full focus helps train your mind to stay grounded. It's also helpful to think about how greed hurts your performance. Think back to a time when you broke your rules because of greed. What happened? Chances are you lost money or felt regret. Use that memory as a reminder that chasing money often backfires. When you remember the pain it caused, it helps you stay disciplined next time. Overcoming greed takes work, but it's possible. By building awareness, understanding the root cause, and training your mind with new habits, you can reduce the power that greed has over you. The
Market
goal
is
isn't
just
to remove
ridiculous, man.
greed completely.
Probably waiting
That's not
for you to
realistic.
know, but
The goal is to stop it from controlling your actions. When you do that, you gain an edge, not just in the market, but in yourself. Chapter 5: Fear. Fear in trading often shows up in many forms, like fear of losing money, fear of making a mistake, fear of missing out, or even fear of being wrong. These fears can quietly control a trader's decisions without them realizing it. But every type of fear has its own reason and pattern. The first important step is learning how to spot it. Just like a trader learns to read a chart,
you can't even
they
talk.
also need to learn to
I
read the
don't know.
signals in their mind. This is done by tracking moments of fear,
But you know,
observing how they feel in the body, what thoughts appear, what happens next, and how it affects a trade. Over time, this helps create a personal map of fear,
I'm going
showing when and why fear shows up during trading sessions. The next important part is understanding that fear is not just an emotion. It's a signal, a message pointing to something deeper. For example, fear of losing money might come from the idea that a person's value depends on winning. So, when they lose, it feels like a failure not just in trading, but in life. Others may have a fear of mistakes because they believe one wrong move means they're not smart enough or good enough. This kind of thinking creates pressure, and under pressure, trading becomes harder, decisions slower, and confidence weaker. There are also traders who feel fear even when they're doing well.
whatever, bro.
For them,
Whatever, man.
success itself
Whatever.
creates stress. They start to worry they'll give back the
Yeah,
profits
I got
or
it.
that this winning streak won't last. This fear of success is usually linked to not believing they truly deserve to win. When that feeling grows, they might start self sabotaging, making random trades or skipping setups to protect themselves from the pain of losing what they never felt was theirs to keep. Fear of missing out is another common issue. Traders chase moves that have already started, entering late and getting bad prices. They know they shouldn't, but the worry of being left behind is stronger than logic. This usually comes from a lack of trust, either in their strategy or in their own patience to wait for a better setup. The fear pushes them to act early, but it ends in poor trades and more frustration. Some traders feel fear because of past trauma in the markets. Maybe they took a huge loss once and never recover emotionally. Now, every time a trade looks like it might go wrong, their brain flashes back to that painful memory. This kind of fear lives in the subconscious and often doesn't respond to positive thinking or willpower alone. It needs deeper work. That includes writing down past experiences, learning what lessons they taught, and slowly building trust again, first in the system, then in themselves. Another type of fear is fear of being wrong. This fear causes traders to hold on to losing trades for too long, hoping the market will turn and prove them right. It's not about the money, it's about ego. Being wrong feels like weakness or failure. But this is dangerous. In trading, being wrong is normal. The goal isn't to avoid being wrong,
Okay.
but to handle it properly, cutting losses early, learning from
We
mistakes,
could
and
flip from here
improving
because
step
this
by
is the
step.
350.
To reduce fear, it's important to train the brain like a muscle. That starts with writing down thoughts and reactions in the heat of the
So
moment.
we could find
The
the
more
lower
this is
tier right
done,
there.
the clearer
The
the
big
patterns become.
previous
With that awareness, it's possible to prepare better. When the same
this is the
fear
midpoint of the
starts
previous
rising
week.
again, traders can recognize it faster and follow a plan they've already created,
We've almost
one that
we
tells
almost
them what
put
to
up
do
there.
next
Yeah,
if
so
they
we
don't
might even
perform
start
from old
going up.
habits. By doing this over time, fear loses its power. It doesn't disappear completely, but it becomes something that can be managed. Confidence grows not by ignoring fear, but by learning how to
Yo, Ali
respond
Wagwan.
to it with clarity
Yeah,
and
it's going
wisdom.
down hard,
The
man.
goal is not to be fearless.
But
The goal is to trade in spite of fear, with discipline, structure, and trust in the process. When this happens, performance improves, and so does peace of mind. Chapter 6 Tilt. Tilt happens when anger or frustration takes over your mind and affects how you trade. It shows up in many forms, and each type needs to be understood clearly so it can be fixed. One common type is called hating to lose tilt. This happens when losing a trade feels like a personal failure. You try to force a win after a loss to feel better about yourself. But this reaction leads to bad trades because your focus is no longer on making the right decision. It's on avoiding the pain of loss. Another type is mistake tilt. This is when you make a mistake like clicking the wrong button or entering a trade too early, and then get so upset that it
like
ruins your
what they had to
mindset.
do is just
You
pull
start
back to the
punishing
midpoint for
yourself.
me, man.
You
I would
lose
have been in this
confidence and sometimes try to make it back by taking
set
quick, careless trades. Injustice tilt comes next.
quick
This
thing
is
as
when
well, you
something
know.
feels unfair, like when your stop gets hit by a single tick
That,
and the price goes in your direction,
that's all right.
or when news comes out of
I'm gonna see
nowhere
if we're
and
gonna
destroys a
reverse now.
perfect setup. Even though you couldn't control what happened, you feel like you were cheated. This
I'm gonna
frustration
run out these
builds,
hours
and
at
instead of
least.
stepping back, you go into revenge mode. That leads directly into revenge tilt, where you take trades not because they make sense, but because you want to get back at the market. You want to prove something. You want to recover what was lost, not through logic or patience, but through force. This often leads to a spiral where the losses only get worse. There's also entitlement tilt, which happens when you believe you deserve to win. You think you've done the hard work, studied the charts, followed your routine, and now the market should reward you. When doesn't, you feel angry. That anger turns into entitlement. You start over
Getting to close
trading
below
when
the
you're
5 minute
increasing your
candle
risk,
low.
thinking the market owes you something. This is dangerous because the market doesn't care about your effort. It only rewards good decisions made
I
with a
really
clear
do want to
mind.
get involved, you
Each of
know.
these tilt types must be treated seriously. To fix them,
I'm gonna
the
wait till the
first step
news is
is
over because
awareness.
I only have
You
one
need to
more
watch
trade for
yourself
today, so I don't want
closely
to risk
and
it.
recognize the early
Um,
signs.
but
Is your
I bought this
performance
on my phone,
changing? Are your
my other
shoulders
account,
getting
this
tighter?
other VG
Are
here.
your thoughts speeding up? These are
Let's do
signals
the
that
1 minute
matter.
till the news
If you can
drop.
spot it early, you have a chance to stop it before it takes control. Writing down these patterns helps. Track when tilt happens, how strong it gets, what triggered it, and how it affects your trades. Over time, this record gives you a clear picture of how your mind reacts under pressure. But awareness isn't enough. You also need to understand the real cause behind the tilt. Maybe you hate to lose because your self worth is tied to performance. Maybe mistakes trigger you because you were raised to believe that failure is shameful. Maybe injustice tilt shows up because you need control to feel safe. These reasons aren't always obvious at first, but with time and honest reflection, they start to reveal themselves. Once the cause is known, you can begin correcting it. That means writing out clear thoughts that challenge the emotion. For example, if you feel entitled to win, remind yourself the market owes me nothing. It's my job to find good trades, not force them. It also helps to prepare mental reminders before you start trading. You can use phrases like, losses are part of the game, or I will not let one mistake control my session. These reminders act like anchors. They help keep your mind stable when tilt starts creeping in. Practicing them
This is the
daily
weekly
builds mental strength, like
level
training a muscle.
here. So
Over
I'm
time,
expecting a good
your ability
reaction
to
of
stay
this.
calm and focused improves, and the hold that tilt once had on you begins to fade. Staying ahead of tilt also means watching what happens after it's over. Many traders feel
I
ashamed
really
when
need them
markets
to
fall,
retrace to the
but
midpoint, man.
those
Don't play with
emotions
me.
can be used to learn. Review your notes,
Like,
identify
don't
what
need to
went
do that, man.
wrong,
This is my
and
first big
adjust your
trade on that.
strategy.
And you want to
If
do that?
needed, take a short break,
No,
walk away
bro.
from the screen, and reset.
But
These
yeah, the
simple
buys here are
actions can
going though.
prevent one bad moment
Ooh,
from turning into
I'm
a
partial.
terrible day.
Okay, thank
You're
you.
not trying to be perfect. You're
No,
trying to improve one tilt at a time
691.
until those old reactions lose their power and you stay in control, no
Yeah,
matter what the market throws at you.
that was a nice partial.
Chapter 7, Confidence. Confidence in trading is not something you either have or don't have.
Nice
It
partial.
is built through
See if
experience,
they keep going.
proven skill, and a clear understanding of how you work as a trader. But just like losses and gains in the market, confidence moves. Sometimes it rises too high
I
and
took
causes
partials right there.
overconfidence. Other times, it drops too low and leads to hesitation, doubt, or fear. The key is learning to manage confidence like a process, not a feeling. It needs to be stable and
Yeah, but I
grounded in
wanted to.
facts, not in hopes,
I'm gonna leave this.
fears, or
We're gonna
outcomes.
leave the
At the
midpoint,
core of
man.
stable confidence is a deep belief in your
Really
ability
want them
to
to come
trade
back here though.
well over time, even when you lose a trade. This belief isn't blind. It's based on knowledge of your
I'm gonna
process,
wait for
your
the news
skill,
regardless.
and
But
your ability to adjust when things go wrong. When confidence is built this way, it doesn't get shaken by a single loss or
yeah,
lifted suddenly by a
I'm in
single
longs
push.
to
It stays consistent because it comes from something real.
Traceman. I want to see
Most
how they
traders
react
lose
when they get to the
confidence
midpoint.
because they tie their self worth to results.
I have an
If
alert
they
right there.
win, they feel good about themselves. If they lose, they feel like failures. This link between results and
Let's
personal value
go a
is
little bit low to
dangerous.
go,
It makes every trade feel like a judgment on who they
but you
are.
can see the
But trading
consolidation
is not
around
about being right all the time.
pairs now.
Even great
Nasdaq as
traders
well.
lose. What matters more is how well you manage
Nasdaq has a
risk,
level all the
follow
way
your
down.
strategy,
I don't
and
know if it's
hold your
gonna get there
stakes.
today.
When confidence gets too high, it creates
So just
overconfidence.
wait.
This can lead to
Nasdaq is
reckless
going out the
trades,
house.
ignoring risk, or believing that you can't lose.
Uh,
It often happens after a strong run of
SPX
profits.
only run out the
The
low.
mind tricks itself into thinking that success will continue just because it has.
Go run out
But
the
the
house
market
now.
does not care about your last trade.
Yeah, they're all looking like they want to
Trading
have a
is a new
retracement.
event, and thinking you're untouchable
You
leads to
steady, that's a
losses that
nice
feel
close.
like a hard slap. Recognizing when you're
It's
slipping
IFE
and
just
building
giving us what we
confidence
want
is important.
for
Speaking
retracement.
thoughts like, I've got this
Once
figured
we get
out,
to the midpoint, we
or
want to see
I
how
don't lose
price will
tomorrow,
react.
these are warning
The
signs.
news as well.
At that moment, you need to slow down, return to your plan, and focus on the process, not the outcome. On the other hand, a lack of confidence shows up as fear, doubt, or avoidance. You might hesitate to take good setups or close trades too early. Sometimes it's caused by a recent loss. Other times, it comes from a deeper problem, like perfectionism or fear of being wrong. The way to rebuild confidence is by collecting proof of what you can do. This means looking at your trading journal, reviewing past trades, and seeing patterns that show your skill. The more real evidence you have, the stronger your confidence becomes. Sometimes confidence is damaged not by one big mistake, but by a long stretch of inconsistency. You may be doing everything right, but not seeing results. This can wear you down. In these moments, it's important to keep perspective. Confidence does not always feel good.
About to hit my break
Sometimes
even.
it means staying steady through a rough patch. Trusting your edge, your process, and your data helps you push through. A key tool for building confidence is journaling. Writing down your trades, your thoughts, and how you felt gives you data to work with. You can spot patterns, identify what's working, and see where your mindset shifts. Over time, this creates a clear picture of your strengths and weaknesses. This picture is your foundation. You can rely on it when emotions try to take over. Confidence also grows when you manage emotions well. When you can handle tilt, fear,
I feel like
or
taking
greed
the
without losing
value
control,
that though.
you start to believe in yourself more. Every time you bounce back from a mistake or trade through pressure, you prove something to yourself. That proof
Because
builds
it's gonna do
real,
something.
stable confidence. It's not about being perfect, it's about being
I'm
consistent,
looking to keep
strong,
scalping on my
and
phone
able
to
to
be honest.
recover. To keep
I can't just
confidence
take these
stable,
trades on
you
lead
need to
plays
review it
on
often.
you know.
Ask yourself, is my belief in myself based on facts or feelings? Am I thinking clearly or am I being pulled by emotions? If your answers show that you're drifting
It's a
instead
one
of
minute fair
racing,
value gap
use
right
your
on the
routine,
midpoint as well.
your journal,
So we
or your
might get a,
experience to ground yourself again.
yeah,
Over time,
might get a news
confidence becomes
pullback
something
to
you
this
can
for us
count on,
to continue to
not just
crash.
something you hope to
But
feel.
my thing is now that we've wicked out this low,
Chapter 8, Discipline.
okay, yeah, now it's
Discipline is
possible that
not
we
about
could
forcing
react
yourself
off
to
the
meet
midpoint
everyone's
only.
goals.
But
It's
usually
about
I'd want them to
understanding
run out
what
the highs
stops
before
you
them
from being
continuing
consistent
downwards.
and learning how to fix it. Many traders think they have a discipline problem, but what they really have is a deeper issue that looks like a lack of discipline on the surface. For example, when someone keeps breaking their rules
Yeah, he
or
hasn't knocked
enters
my break
trades
even.
too early or too late, they believe they simply lack control. But the real problem often comes from emotion, like fear, greed, or overconfidence, that pushes them to act in ways they know they shouldn't. Discipline problems can appear in many forms.
4 hour candle.
Sometimes a trader
Gonna
jumps
do
into
a quick
trades
move
without waiting
tonight.
for a proper setup.
I feel
Sometimes
like
they
I'm
close a
just
trade
go up
too
the
early
pay for
just to
once.
feel safe. Others may overtrade after a win,
5
thinking
a.m.
they're
open.
hot.
And
All
continue.
these actions look like a lack of discipline, but they are just symptoms of something deeper. To solve these issues, it is important to understand what is really happening underneath. This process starts by mapping when the mistakes happen, what
BPR.
you're thinking and feeling at that moment, and how your performance is being affected. A strong way to correct these problems is to use mental reminders and structured routines. These tools help
I'm
bring
gonna
your
cash
focus
out again
back
right
when you
here.
feel pulled by emotion. For example,
Check.
if you're someone who gets bored and starts taking random trades, then your routine must include small actions to keep your brain engaged. That could be reviewing charts, practicing your strategy, or even stepping
For
away
my
for a few
entries
minutes.
on my
The
like when
goal
I'm being
is not to
serious
make
and stuff,
emotion
yes, I stick to the
overcome
5 minutes
mental
on my
action. Discipline can also break
because
down
I have
habits
certain
without
levels I'm
preparation.
looking at price.
Many
Not
traders
waiting
think they
for
are
a pattern.
ready just because they show up in front of their
I have
screens.
certain price levels
But
that
real
I'm waiting for
preparation
price to
involves getting your
get
mind
to.
clear, reviewing your trading plan, checking your emotional state, and reminding yourself of your key
Check
goals.
your Instagram,
This helps
bro.
stop you from chasing trades or avoiding trades out of fear. A simple pre market routine, done every day,
I
sets the
did buy
tone
the
for
1 minute
confidence.
IFVG on my phone
Without this
though,
preparation,
so
even the
I'm not
best
gonna take it
strategies
on a
can fail.
proper account.
Another reason traders lose discipline is because of their focus on results. When you care too much about making money, every trade starts to feel like a test of your worth.
All right,
If the trade
news
wins,
coming out
you
now.
feel good. If it loses, you feel frustrated or scared. This emotional pressure causes traders to make decisions
Probably
that
gonna
are
go up to the
illogical.
midpoint for
The
us.
solution is to
Should be good.
focus on execution instead of outcome. This means putting your full attention on following your
Looking at
plan and trading your edge, even if the result is a loss. Over time, this habit builds true discipline. There are also times when lack of discipline comes from a weak routine after the trading day ends. Without a proper review process, you can't
All
see
right, so we
patterns
have
or
our 30
mistakes
minute as
or
well.
understand what needs to change. Taking time to
Get
reflect
that.
on how your emotions affected your decisions, what went well, and where you slipped gives you the power to improve. Writing down your trades, thoughts, and feelings builds a feedback loop that sharpens your control over time. Many traders
So
don't
now I want to
realize
see
their
price
lifestyle
react to the
outside
midpoint
of
of
their
the 30
trading
minute and the
affects their
midpoint of the
discipline.
5 minute.
Poor sleep, Bad diet, lack of exercise, and personal stress all make it harder to focus and follow through.
All right,
If
cool.
your
I'm gonna
energy
see a
is
reaction
low
from
and
here
your
now.
mind is scattered,
I'm
you're
still in
more
my bars on
likely
my
to
phone.
break your rules. That's why maintaining a healthy routine outside of trading is just as
Yeah,
important as what
rejection
you
from
do
here.
during market hours. Discipline is not something
If
you
not,
either
we're going to
have
the highs.
or don't have.
Ooh,
It is a skill that can be built. You do
1 minute
this by
bars are
tracking
running
your
though.
patterns, understanding
It's
the
crazy.
real cause of your mistakes, building routines, and
For
focusing on
real.
execution instead of emotions. With time and effort, what once felt difficult will become second nature. When your actions start matching your knowledge consistently, that's when you know discipline has taken root.
This is wild.
Chapter 9: Correct your
It's gonna
problem.
take some more
Let's now
passes
move
here.
forward into a crucial part of your journey. You've already learned how to spot your trading mistakes, you've mapped your emotions, and you've explored the root causes. Now, it's time to apply what you've discovered. This section is all about how to correct those mental errors in real time while you're trading. It's about building a process that works like a shield when pressure rises and your emotions start to take over. The goal here is to stop
I'm
your
not done with the
mistake
bear
before it
side.
grows
Honestly,
bigger and to get back into the right mindset
I'm
fast.
looking at how
To
much we
start with, the first thing you need to do
grab a
is
candle.
recognize when the problem is happening in the moment. This is not always easy, but it's essential. Most traders realize a mistake only after it's done. That's too late. The real progress comes when you
That's
notice
too
the
late.
signs
This
early,
trade is
when
running
you
now.
feel the stress, hesitation,
Damn.
overconfidence, or tilt creeping in. At this stage, you're not trying to solve the deep cause instantly. You're trying to stop the pattern from running wild. You step in between the trigger and the action. This is what's called an intervention. This intervention starts with a mental routine. A short mental script helps you interrupt the pattern. You might say something to yourself like, pause. Something's off. Step back. This short line becomes a signal to stop trading for a moment, take a breath, and reset your focus. You don't need a long speech, just a clear, strong reminder that you're stepping away from a mistake before it takes over. After you interrupt the pattern, you then bring in logic. You bring back the reasoning that helps you stay grounded. This could be a reminder of your edge, your plan, your expected outcomes. Maybe you say, my edge plays out over many trades, not just this one, or I don't need to make it all back today. This logical reminder reconnects you to the right mindset and weakens the emotion trying to push you into error. Once you've done this mental reset, you return to trading.
Weak.
But now you're more alert. You've kept the problem from growing. Even if the emotional pull doesn't disappear fully, it has lost its strength. The mistake didn't control you. That's a win. Over time, as you keep doing this, your mind learns to stop the problem earlier and earlier until one day it doesn't show up at all. This is how real change happens. Now, this moment of correction is only one part of the system. To support
These
it,
guys are
you need
running
a
around.
proper routine that wraps around your trading day. This means having a strong preparation before you trade. You spend time reviewing your maps, reading your mental reminders, and preparing your mind for what's coming. Then, during the trading session, you stay aware. If problems start to rise, you use the intervention process. After the session, you review what happened. You write down what worked, what didn't, and how you handled your mental game. This routine, repeated every day, builds control, insight, and strength. The correction process also depends on how well you understand your patterns. If your emotional map is weak or if you don't know your triggers clearly, then your correction will be slow. So, the deeper your self awareness, the better your results. You're not trying to be perfect, you're trying to keep your worst moments from dragging down your performance. It's also important to be honest in your review. Some days you'll slip. That's normal. What matters is how you learn from it. Go
Them
back,
guys running,
review what
boy.
happened, update your notes, and sharpen your process. If you continue to do this, your system gets stronger and your emotions
Let's
lose
start
power.
that.
You begin to trade
We're
with more
100 and
consistency, and
over
your mental
200
game
points.
becomes your edge.
150 points.
Remember, correcting a problem over time is a skill. Like any other trading skill, it improves with practice. You're not aiming to erase all emotion, but to manage it wisely, to pause at the right time, and to return to logic when
Don't
it
worry, guys.
matters.
The market is
That's
going
what
through it.
separates consistent traders from those
They're gonna
who
start giving us
only
what we
make the
want in a
same
bit.
mistakes.
Obviously, like
You now have the tools. The next
saw
step
this
is to
reversal
use them
mile away.
every day in
As soon as we
different
hit this
trades.
higher time frame
And with
level,
time, Your mental game will become one of your strongest assets. Chapter
This is
10:
this is not what you want to be
Troubleshooting
putting risk
rapid
in. I'll be honest
progress.
with you.
Sometimes,
This is
even when
rubbish.
everything seems to be in place, routines, journaling, emotional maps, and correction strategies, progress just stops.
Let's see,
The
man.
mind starts to
If you start,
question
you know
why
what I'm saying?
things aren't improving. It feels like a puzzle where the pieces no longer fit.
Pull
This
back will go
section is about
longer.
fixing that pause, not by
Don't
pushing
know,
through, but by understanding what's actually going
It's
wrong
crazy because
on
I
the
actually
surface. The goal is not to find a new strategy or
actually
trading
want us
approach.
to come run
The
out this
goal is to remove the obstacles that are blocking your ability to
at some
apply
point
what
in
you
the
already
week.
know. The first step is to check if you're actually following the process correctly. Maybe you're just going
But
through
as
the
long as we
motions,
keep going up,
writing notes
going
down
up,
after a trade, but not thinking deeply about what they mean. Trying to correct
we have a
emotions
4 hour
quickly,
gap now.
but without
We've
strong
closed up a
mental
4 hour. This is the
preparation for
first
the
fair value
execution.
gap
In these cases, the solution is to increase
for the
focus
week.
and effort on the system
But
itself.
my problem is now
Recommit
we're going to
to
do this to
mapping.
downside
Review
first.
your emotional patterns carefully
Um,
and make sure you're doing the pre and post trade routines with full awareness. Don't let the process turn into a checklist. Every step must be intentional. Otherwise, the mind starts to treat it like a chore and progress slips away without you even noticing. If the process is solid, but you're still not getting better,
I
it could be
literally
an emotional
I had a
setback.
swing
It's
trade
worth checking if the issue you're working on is still driven by
from
emotion or if it's become a
yeah.
habit. For example, if tilt still
This one has
happens,
hit
but the
TP already.
emotion behind it is no longer strong,
But
that means the emotion has
one
already
price to come
faded,
all the way down
but
here.
the reaction remains. Now, it's just a pattern you've repeated
Only gone
so
about
many
600
times that it
points for the week. We
happens
can still get all the
automatically.
way to
At
800.
this point, you don't need to focus on
So
emotional mapping
unless
anymore.
price reverses
Instead,
now,
focus on
I'm gonna
rewiring the
keep
mind.
looking for sales.
That means using real time strategies over and over again until new habits replace the old ones. Don't wait for emotions to fade away
Traded to
completely.
50% right now.
Shift your attention to discipline, repetition, and conscious correction. Another roadblock can come from pressure. Sometimes traders get so focused on
Like where this
fixing
is
themselves
going,
quickly that they create stress around progress. That stress interferes with clear thinking and the ability to stay calm during trades. It creates a situation where the desire to improve actually causes more mistakes. The way out of this
you
trap
try to
is to
sell.
shift your attention away from results and focus only on execution. Let the progress come as a side effect of doing the right things well. If you keep checking your performance too
Still
often,
going up
it
though.
becomes harder to concentrate on the present moment. You start trying to prove that you've changed instead of actually changing. Sometimes the problem is not even related to trading. There may be stress in other parts of life,
Alright, I'm
relationships, health, money that
gonna
spills
try to
into
short.
trading day. This kind of pressure is tricky because it feels like a trading issue, but it's not. In this case, the solution is to step back. Look honestly at what's going on outside of trading.
I'm gonna
Are
try
there
to short here.
worries that keep showing up in your thoughts during trades?
50
Are you
pound stop loss.
carrying emotional weight from something else? If so, working harder on trading won't solve the problem. What's needed is attention and care in that area of life. When that emotional pressure eases, trading performance often improves without any new technique. Another hidden block is burnout. This happens when the mind has been working hard for too long without rest. You might still be pushing forward, but the energy and clarity just aren't there anymore. It feels like the engine is running, but the wheels aren't moving. In this case, taking time away is not laziness, it's necessary. A real break helps the brain reset. When you come back, motivation and focus are stronger. Finally, there's the possibility that progress is happening, but you can't see it because your expectations are too high. Improvement is often messy. It doesn't always look like a straight line. There are ups and downs. Small wins can go unnoticed if you're only looking for big
I
changes.
honestly want us to
Go
close
back to your
bearish.
notes. Compare how you used to respond with how
So
you respond now.
to
Even small
300 points.
differences, pausing before reacting, reducing the size of a mistake, can be signs of real growth. Recognizing those steps helps keep motivation alive and reminds you that the work is paying off. By understanding and fixing the real reasons behind slow progress, you get back on track. The mind becomes clearer. The system starts working again. And with it, growth returns, not as a burst of luck, but as a steady process you can trust. system starts working right, and with it, growth returns, not as a burst of luck, but as a steady process you can
So my
trust.
confluences for this trade is we have our 4 hour fair value gap, and we've just come and closed out 50% of the um new day opening gap. So let's see, we have price continue to drop for us. At this point, I wouldn't want it to really get to the 0.25. I think the zero point 0.5 is enough. So my confluences for this trade is we
Whoa.
have our 4 hour fair value gap, and we've just come and closed out 50% of the. Shut up. Why isn't this? I'm not betting. I'm, I'm predicting it's going down, bro. There's confluence behind this.
If you're someone who stares at the trading screen with a storm in your chest and silence in your strategy, this audiobook is for you. Before we begin, don't forget to like, share, and subscribe to the channel for more powerful audio.
Probably need a mindset
One,
shift.
the rich
Ready?
don't work for money. When I was 9 years old, I asked my dad a question that changed my life. How do I make money? He didn't give me an answer right away. Instead, he told me to ask Mike's dad, the father of my best friend. Mike's dad was a businessman who owned several companies. He didn't finish school, but he knew a lot about money. That day, I started a new journey with him. He became my teacher when it came to money. Mike and I were eager to learn. We wanted to get rich. So we went to see his dad and asked him how to make money. He looked at us, thought for a moment, and then said he would teach us if we really wanted to learn. He warned us that the lessons might be hard. We agreed, ready for anything. The next Saturday, he gave us our first job. We worked for one of his small stores. Our job was simple. We had to clean the shelves, dust the items, and do small tasks. For this, he paid us 10 cents an hour. At first, we thought it was great. We were getting paid. But after 3 weeks, we were tired, bored, and upset. We were working hard and not making much money. I felt like quitting. I decided to talk to Mike's dad. I wanted a raise. I was nervous, but I went to his office and told him I didn't like the job and the pay was too low. He looked at me carefully, then smiled. He said, "Now you're learning." I didn't understand what he meant. He explained that most people work for money, but the rich make money work for them. He told me that if I kept chasing a bigger paycheck, I would fall into a trap. Instead, he wanted me to see how the
Yeah.
system works. Then he said something strange. He told me he had been waiting for me to complain. He wanted to see if I had the courage to speak up. He was teaching me a lesson, not just giving me a job. He explained how people let fear and desire control their
If
decisions.
you start going any
Most
higher,
people
then
are
prices
afraid
then
of
go
being
to the
poor, so they work hard to
highest
earn
level
money.
or whatever.
Then, when they have money, they want to buy more things. They get stuck in a cycle of working and spending. He wanted me to see that. He told me to pay attention, to watch how people behave when it comes to money.
Yeah.
They wake
Look
up,
at that.
go to work,
Perfect.
earn money, pay bills, and repeat.
Nasdaq as well.
They don't
Yeah.
stop to ask if there's another way. He said that real learning starts
Now
when you stop reacting to money and start thinking differently.
can all flip.
I asked him
Actually.
what I should do next. He said I could quit if I wanted, or I could stay and learn something valuable. I chose to stay. The next lesson came in a strange way. He stopped paying us. We still worked the same hours at the store, but now for nothing. At first I was angry. I felt used. But then something changed. I began to look around the store more carefully. I noticed how the store worked. I saw which products sold fast, which ones didn't. I saw how people behaved, what they liked to buy. I started to think about how money was made, not just earned. One day, I saw that comic books were being thrown out because they couldn't be sold anymore. I asked the store manager if I could have them. He said yes, as long as I didn't sell them. I took them to Mike's house. We set up a reading room and charged kids a fee to come read the comics. We made more money that week than I had in all the hours I worked in the store. I had learned how to create something from nothing. That was when I truly understood what Mike's dad meant by making money work for you. After this, he sat us down and explained more. He said, people often blame others,
All
the
right, let me.
press, the economy, the
This is
government,
why.
for their money
Hold on.
problems. But real power comes when you stop blaming and start learning. He told us that money is just an idea.
On the
If we
4-hour
could
chart, we
train
have
our minds, we could
it
see
open.
opportunities others missed.
We
He
opened
reminded
here.
us that school
We've been
teaches you how to make
consolidating. We
money,
had a
but
displacement
life can teach you
of
how to make
the
money
fair
work
value
for
gap.
you,
So
if you're willing
it's
to
the
learn.
first retest of the fair
Chapter
value
2:
gap. So
How
unless
to
we close
Teach
above this,
Financial Literacy.
still bearish
When I was young,
the
I
week.
began to
So I
notice
need them to
something
close
that
above
made
this 4-hour
sense.
fair value gap
People
before I
worked
start looking
hard
for
their
my buys.
entire
So
lives, but
probably
still
tomorrow or
struggled
something.
with
But
money. They had jobs,
I
they got
understand we've
paid,
had a
but at the
deep
end of the month,
pullback.
there was little left. I
So
started asking
if it takes me
questions,
out, it takes
real
me out, you know?
questions about how
That's
money
not a
works.
trader. That's it.
That's when I understood why learning about money is more important than just earning it. Most people think having a job and earning a good salary is enough, but the real problem is not how much money you make, it's
So
how much
bottom
money
wick of
works for
100
you.
and something points.
I saw many people get raises only to spend more. They would buy bigger houses, new cars, and expensive things. They thought they were building wealth, but in reality, they were falling deeper into debt. This is why I started focusing on something I call financial literacy. It's the ability to understand how money really works. It's knowing the difference between assets and liabilities. It's not about how many hours you work. It's about what you do with the money you earn.
Yeah, that's
I
perfect.
learned early
Like
that
there's
most
nothing
people
wrong.
don't make
Don't get it
money
twisted.
because
Like the
they
market is
think
not the
they
best right
make
now. So
money. They make money work for them.
and I know that.
And they do
So
this by
I could
buying
stay out, fair
assets.
enough.
An asset is something that puts money
But
in your pocket.
not taking
It
the
could be a
trade.
rental
Not
property,
the trade
a stock
idea is
that
valid to
pays
me. This
dividends, or a business that generates income. A
period
liability,
we're in
on the
right
other
now is
hand,
not the best.
takes money out of your pocket. It could be a fancy car, a big house, or anything that costs money to maintain. Many people buy liabilities
It's
thinking they
part
are
of the
buying
game, bro.
assets. For example, they buy a house and
You don't
save
have to
money for
mention everything that
emergencies.
happens.
But if that house is not making money, if it is only costing them in the form of mortgage,
When I took the
taxes,
buys, you
or
didn't say anything
interest,
about the
then it
buy.
is a liability. That's the mistake most people make. They think they are building wealth, but they are actually buying things that reduce their cash flow. To truly become rich, I realized I had to focus on building my
Because my buys
assets.
here are still running.
Every
This
dollar
is a
I
challenge
saved, I
account.
looked at it as an employee. That dollar's job
I'm
was
still
to
in
go out and
this,
bring
like,
back more dollars.
so.
I didn't want to work for every dollar. I wanted my dollars to work for me.
Did you take the buys from here?
This shift in thinking started small.
Okay.
I didn't have a lot of money at the beginning, but I started learning, observing, and acting. I would read about investments, real estate, and business. I watched how wealthy people behaved. I began buying small properties that could rent out and give me a little income. I reinvested that income into more assets. As time passed, my asset column grew. The income from those assets started covering my expenses. That was the point where I didn't have to rely on a paycheck anymore. I had money coming in even when I wasn't working. That's financial freedom. It doesn't mean you stop working. It means you have the freedom to choose what you want to work on. The biggest problem I saw was that schools don't teach this. They focus on reading, writing, and math. They teach you how to get a job, but not how to manage money. They never explain the difference between an asset and a liability. As a result, many people graduate, get jobs, and earn money, but still live paycheck to paycheck. They don't understand how to make money work for them. I also noticed that many parents can't teach their kids about money because they never learned it themselves. So the cycle continues. Children grow up copying the same mistakes their parents made. They work hard, spend more, and end up stuck.
This
That's
5 minute
why early
BTR just
financial education is more
gave it all.
important than ever.
So we failed to
It's
close.
not just about saving money or cutting expenses. It's about understanding the flow of money. It's about knowing where your money goes and how to make it grow. It's about building assets that pay you again and again. Money has its own language. Once you learn to speak it, you can start seeing the world differently. You can spot opportunities where others see problems. You can make better decisions, avoid traps, and build a future that doesn't depend on luck or a steady paycheck. Chapter 3: Mind Your Own Business. I remember when I was still working jobs for a paycheck, I would hear Rich Dad tell me again and again to mind my own business. At first, I didn't fully understand what he meant. I thought I already was working in my own business. But he explained that when most people have a job, they are really spending their whole lives working for someone else's business, the bank and the government. He wanted me to see that while a job could pay the bills, I needed to use my income to build something that belonged to me. He called it building my asset column. He said that no matter where I worked, I needed to focus on acquiring assets that would generate money even when I wasn't working. As I listened to him, I realized that most people work for others their entire lives and forget to build anything of their own. Their time and energy go toward making their employer rich, while they are left with little more than their wages. He reminded me that even though I might have a job or even a professional career, that was not my business. My real business would be the investments and income-generating assets I was building on the side. This is where I should focus my efforts. He told me that this was the difference between those who struggle financially and those who achieve financial independence. He showed me how important it was to use part of my income to buy or create things that put money into my pocket. He explained that assets were things like rental properties, stocks, bonds, royalties, or a business system I could own. He said that if I was working for someone else, I should be careful not to spend everything I made on expenses and luxuries. Instead, I should make sure a part of every dollar I earned went toward growing my asset column. He said the poor and middle class tend to buy liabilities they think are assets, like new cars or bigger houses that only take more money out of their pocket each month. He told me to avoid that mistake and always ask if what I was buying would feed my business or take from it. I could see how this made sense because many people buy houses thinking they are an asset, but he explained that a house costs money every month. Unless it was producing cash flow, it wasn't helping build wealth. He showed me how to look at my personal financial statement and see the truth. If I wanted to get rich, I had to increase the number of assets I owned and reduce the things that drained my cash. He also made it clear that I didn't need to quit my job to do this. I could start small and grow over time. He said that the trick was to use my job to provide the seed money I needed to buy or build assets. He told me to stay disciplined and patient because the results would come slowly at first. But if I kept adding to my asset column, eventually my assets would earn more money than my job did. When that day came, I would no longer be dependent on a paycheck. I started to see examples of how the rich were building their own businesses all the time. They would invest in stocks, real estate, or companies while still working elsewhere. Rich Dad would say that every dollar I earned had the potential to work for me, but I had to make the choice to send it into my own business rather than someone else's. He told me that the key was to think long term and remember that my job was temporary. The business I was building through my assets would be permanent. From that point on, I began to take every opportunity to buy or create things that could grow in value and produce income. I worked to keep my expenses low so I would have more money to put into assets. I started small, but with each investment, I felt my business growing stronger. I knew that this was the path to becoming financially secure, and I followed it step by step until my assets could support me completely. Chapter 4: The History of Taxes and the Power of Corporations. In school, I'd been taught that taxes were created as a way to make the rich pay their share to help society. That was what most people believed. But what I learned from my rich dad was completely different. He explained to me that when taxes were first introduced, they were aimed at the wealthy, and the middle class supported this idea because they believed it would not affect them. Over time, the burden shifted, and the middle class became the primary group paying most of the taxes, while the rich found ways to legally avoid them. This shift happened because the rich understood how to use the system to their advantage. Rich Dad explained to me that one of the most powerful tools the rich use is the corporation. He told me that corporations are not big, scary things that only giant companies use. A corporation is simply a legal entity that offers protection and advantages that individuals cannot get. The biggest difference is in how income is taxed. An employee earns money, pays taxes first, and then spends what is left. A corporation earns money, spends what it needs for its operations, and then pays taxes on what is left. This allows corporations to spend before they are taxed, while individuals are taxed before they spend. He showed me how the rich set up corporations so they could take advantage of this difference. Through a corporation, expenses like travel, entertainment, and even some forms of education could be paid before taxes were calculated. This meant the money used for those expenses was never taxed. On the other hand, employees paid taxes on their full income and then had to use what was left to cover similar costs. This gave the rich a huge advantage in building wealth. I learned that taxes for corporations were much lower than what individuals paid, especially if those corporations were structured correctly. Rich Dad often reminded me that this was not about breaking the law, but about understanding the law and using it smartly. He encouraged me to see that the system rewarded people who learned how to play the game, and corporations were a major part of that. He also explained to me why the middle class struggled with taxes. When governments needed more money, they often raised taxes on employees because it was easier to collect. Employees were used to having taxes taken straight from their paychecks, so they rarely noticed the full impact. The rich, on the other hand, had more control because their income often came from investments or businesses. They could legally adjust how much they reported as income by using deductions and expenses within their corporations. Rich Dad taught me that this knowledge was just as important as making money. If someone didn't understand how taxes and corporations worked, they would always be at a disadvantage no matter how much they earned. He wanted me to realize that money flows to those who know how to manage it and away from those who don't. I began to see how the rich use the laws to protect themselves. By owning corporations and knowing how to use them, they could reduce their taxes, protect their assets, and grow their wealth faster. Corporations were like a shield. If someone sued an individual, all their personal assets were at risk. But if they sued a corporation, only the corporation's assets were in danger, leaving the owner's personal wealth protected. This was a layer of security that employees rarely had. From that point forward, I understood that learning how taxes worked and how corporations could be used was not optional if I wanted to build wealth. It was part of the education Rich Dad insisted I needed. He believed that most people ignored this kind of knowledge because they thought it was only for lawyers or accountants. But he told me that even a little understanding would make a big difference in how I handled money. That lesson stayed with me for the rest of my life. Chapter 5: The Rich Invent Money. I remember standing in the middle of a crowded market, watching how opportunities seemed to pass by most people unnoticed. There was so much happening around me, but very few could see beyond the surface. Most people waited for the perfect time to act, believing that the right opportunity would simply appear. I realized early on that wealth is not found by waiting, it is created by recognizing what others overlook and making decisions when others hesitate. I learned that the world is full of chances to grow money, but they often come disguised as problems or risks. Many people are afraid to take risks, and because of this, they miss out on opportunities that could change their lives. I watched friends and coworkers stay stuck in jobs they disliked, waiting for a raise or promotion that never came, while others with less money but sharper vision stepped forward and built something bigger. I began to see that those who acted quickly and intelligently, even when the situation felt uncertain, gained an advantage that others never did. There was a time when a small piece of real estate became available at a price far lower than its real value. Most people looked at it and assumed there was something wrong. They moved on without a second thought. But a closer look revealed it was simply overlooked, a hidden opportunity waiting for someone willing to investigate. Buying that property and improving it increased its value many times over. Opportunities like that came and went, and each time the lesson was the same. The people who knew how to move decisively gained rewards, while those who hesitated found themselves standing still. I also understood the importance of creativity when it came to money. There was a time when I had very little cash, yet I wanted to invest. Instead of giving up, I looked for ways to make the deal work. I would search for financing, partnerships, or ways to leverage what I already had. This approach allowed me to step into opportunities that others believed were impossible. It became clear that money is not always needed to make more money. What is truly needed is the ability to see possibilities where others see only barriers. I spent time learning how money flowed through different types of investments. Stocks, real estate, and businesses each followed their own patterns, and by studying them, I could spot when they were undervalued or ready for growth. When the market slowed and everyone was selling, I would often find the best deals. Many people thought it was too dangerous to buy when prices were falling, but this was often the perfect time to act. The ability to make decisions while others were stepping back allowed me to buy at the right moment and later sell at a profit. There was a particular moment when I invested in a property that most people ignored because it was in poor condition. I repaired it, improved its features, and transformed it into something valuable. The return on this effort was far greater than what I would have earned by simply saving my money in a bank account. These experiences taught me that creating wealth often meant going against the crowd and trusting my knowledge and preparation rather than public opinion. I learned to always look for solutions, even when the path forward was not obvious. If I wanted to invest but lacked the money, I searched for partnerships or financing options instead of walking away. If I wanted to buy a property but could not afford the full price, I considered ways to negotiate better terms or trade something of value. By constantly thinking about how to make a deal work, I developed the skill of creating opportunities instead of waiting for them to appear. Over time, this way of thinking became a habit. I realized that chances to grow money exist everywhere, but they only reveal themselves to those who are prepared to act and willing to think differently. While others spent their time wishing they had more money, I focused on seeing what was possible with what I already had. That approach allowed me to step into opportunities that others missed, and each successful step made it easier to take the next one. Chapter 6. Work to learn. Don't work for money. When I was younger, I decided to join the Marine Corps. It was not because I needed the money, but because I wanted to gain skills and experiences that I could not learn elsewhere. During my time there, I learned discipline, leadership, and how to work under pressure. These lessons stayed with me long after I left. After the military, I went on to work for Xerox. Again, it was not for the paycheck. My goal was to learn how to sell because I knew sales was one of the most important skills anyone could have if they wanted to succeed. At first, I struggled. I was nervous and uncomfortable, but I kept practicing. Over time, I became one of the top salespeople in the company. The idea of learning, instead of just working for money, became clearer to me. Many people focused on earning a paycheck, but I wanted to understand different parts of business. I realized that most people specialized in one area, like accounting or engineering, and stayed in that field their entire lives. While that can bring security, it also limits how much you can grow. I wanted to be a generalist. I wanted to know a little bit about everything: marketing, management, communication, investing, so I could see the bigger picture. When I was working at Xerox, I was offered promotions and higher pay, but I turned them down. I knew that if I stayed, I would become too comfortable. I wanted to learn new skills, not just climb a ladder in one company. I decided to leave and take jobs where I could learn more about business as a whole. I worked with small companies, learned how to manage people, and learned how money actually moved through a business. There was a time when a woman asked me for advice. She wanted to write, but was struggling to find success. I suggested she take a job in sales, perhaps selling books or related products. She immediately refused because she thought it was beneath her to be in sales. This was a clear example of how people often hold themselves back. They do not want to learn skills that could help them because they are worried about how it looks, or they only think about money in the short term. I also remembered advice from my rich dad. He always said to pay close attention to the different skills you can gather along the way. If you know how to handle money, how to sell, how to lead, and how to manage, you can build strong businesses or investments. People who only know one skill often depend on others who know the other parts, and this keeps them stuck. I noticed how companies were organized. Most people at the bottom worked for money. The middle managers kept the system running. At the top, the leaders usually had broad skills. They understood enough about every part of the business to make good decisions. I wanted to be like that. Learning how to communicate clearly was another important lesson. The ability to speak and write well could open doors. It could help you explain your ideas, lead teams, and attract opportunities. That was why I worked hard to practice sales and public speaking, even when it was uncomfortable. Over the years, I continued to add new skills. I did not stay in one role for too long because I wanted to keep growing. When I looked at the most successful people I knew, I saw that they had all learned many different skills over time. They did not always take the highest paying job right away. Instead, they chose paths where they could learn, even if it meant starting lower. By focusing on learning rather than just earning money, I built a foundation that would help me for the rest of my life. I was no longer tied to a paycheck or one company. I could move forward with confidence, knowing I had the knowledge and ability to create opportunities for myself. Chapter 7: Overcoming Obstacles. I often see that even when people know what they need to do to improve their financial life, something stops them. Over the years, I realized there are certain things that hold most people back from achieving financial success. The first one is fear. Many people are afraid of losing money, and this fear controls their decisions. When I was learning about money, I too faced this fear, but I learned that losing money is part of the process. Those who are afraid to lose often avoid taking opportunities. I discovered that the key is not avoiding losses, but learning how to handle them and move forward. Cynicism is another obstacle I noticed. People often doubt everything. They say, "What if the market crashes?" Or "What if the investment fails?" This questioning can kill good opportunities before they even start. I learned that there will always be reasons not to take action, but those who succeed find ways to overcome their doubts. I remember a time when I wanted to invest in a property, but those around me filled my mind with negative thoughts. If I had listened, I would have missed a great opportunity. Laziness is another problem. It does not always show up as doing nothing. Often it appears as being busy with other things. I once met someone who always said they were too busy to look into investments or learn about money. In reality, they were avoiding the effort required to grow financially. I understood that making time for building wealth is necessary. Saying, I am too busy, is often an excuse. Bad habits can also stand in the way. I learned that many people spend money on things they do not need before they invest in their future. Paying yourself first is something I practiced. This means setting aside money for investments before paying bills or spending on luxuries. It can be difficult, but when I did this, I saw my investments grow, and over time it became a strong habit. Arrogance can be just as damaging. Some people believe they already know everything, and this stops them from learning more. I knew someone who lost a lot of money in the stock market because they refused to take advice. They thought they knew better than everyone else. I understood that it is important to stay open to learning and to listen to those with more experience. There was a time when I was faced with a real estate deal that looked risky. I had all the doubts in my
Yo,
mind.
Ali, do you see the
I
vision
decided to
now?
study the deal carefully
All right,
and talk to experts.
cool.
I took action because I understood that fear and doubt could not guide my choices. That deal turned out to be a success. Experiences like this taught me that each obstacle could be overcome with the right mindset and actions. To move forward, I made a habit of asking myself how I could afford something instead of saying I could not. When a new investment seemed out of reach, I asked, how can I make it possible? This
It
simple
was the right
question
time
helped
for
me
a
find
pullback.
solutions I would not have seen otherwise. I also surrounded myself with people who inspired me and knew more than I did. Their knowledge helped me make better decisions. Whenever I faced difficulties, I looked for solutions
I'd
instead of
honestly want
excuses.
price to still come all
I
the way
saw that
down here.
every obstacle had a lesson in it, and once I learned the
Should we take one
lesson,
more
the
trade?
obstacle was no longer a barrier. By understanding and facing these challenges, I was able to keep
We take
moving
one more
forward.
trade.
The journey was never about
All right. So what I'm
avoiding
gonna do is,
difficulties, but learning how to deal with them.
all right, I'll be looking
This
to take
approach
this
helped me find
60-point trade.
opportunities that others
I'm gonna put
often
an offer
missed
here.
and allowed me to grow financially step by step. Chapter 8: Getting Started. I learned that the first step to building real
Don't get
wealth
shook.
is to make a clear
Trust the
decision.
process.
Without a strong reason to keep going, most
We're
people
looking
quit
for
when
something
things get
to do.
difficult. That is why I focused on finding a
If we
powerful purpose. I asked myself why I wanted to be rich and what kind of life I wanted to create. Once I understood the reason, it became easier to move forward, even when the path was uncertain. The next step was to find role models. I looked for people who were already successful in the areas I wanted to master. Observing how they worked and learning from their examples helped me to see the possibilities. I spent time listening carefully
you
to
don't say
share
anything
about
when I
their
win.
experience.
That's not good.
This gave me new ideas and showed me that success leaves clues if you pay attention. It was also important to take small, practical steps
And that's
instead of
why I
waiting
close
for the
right there.
perfect moment.
For the
I
higher
did not
level.
have to start big. The key was to start. I began by focusing on a single strategy that I could understand and practice well. Trying to do everything at once would have led to confusion, so I committed to learning one thing, applying it, and getting better as I gained experience. One of my habits I developed early was paying myself first. Before spending money on anything else, I made sure a portion went straight into
Yeah, yo.
investments. This meant that I was always growing my investments before paying bills or buying personal items. Even when money felt tight, I kept this rule because it forced me to think creatively and find solutions instead of using that money for quick comfort. Building wealth also required surrounding myself with people who were smarter than me in specific areas. I sought out accountants, brokers, and other professionals who could guide me in making better decisions. I listened carefully to what they said and used their knowledge to avoid mistakes I might have made on my own. Another lesson was the value of giving. I learned that when I gave knowledge, resources, or help to others, opportunities often came back in unexpected ways. It was not about expecting anything in return, but about creating a flow. Helping others often opened doors and built strong connections with the right people. I kept educating myself every single day. Reading books, going to seminars, and learning about different markets became part of my routine. Each piece of new information gave me an advantage and allowed me to see opportunities that others missed. I realized that financial education was not something I could study once and forget. It had to be an ongoing process. I also understood the power of taking action quickly. Many people spend too much time thinking and never start. I decided to look for opportunities constantly and act on them when they made sense. It could be something as simple as checking the real estate listings or visiting a property that caught my attention. The more I practiced,
Do we
the
want to go
easier it
closer?
became to recognize deals that could work.
Are you visual here or do you
Finally,
feel
I reminded myself that mistakes would
downside?
happen. When they did, I used them as lessons and kept moving forward. I knew that sitting still and doing nothing would never create progress. Every day was a chance to build more experience and get closer to financial independence. Starting the journey required clarity, persistence, and daily effort. I built habits that focused on acquiring assets, learning new skills, and connecting with the right people. Step by step, the
You're
actions became part of my life, and with time, the results started to show. Chapter 9. Still want more? Here are some to-dos. I want to share some clear actions you can take if you truly want to change your financial life. The first step is to start looking for ways to build your financial intelligence every single day. Begin by paying yourself first. This means putting money into your investments and savings before you pay your bills or spend on anything else. By doing this, you build the discipline to grow your money and create a habit of making your assets a priority. Another important action is to set clear goals. Write down what you want to achieve financially and how much time you're willing to give yourself to get there. Keep those goals in front of you at all times. When your goals are clear, you will notice opportunities around you that you never saw before. Each step forward will help you get closer to financial independence. Start small if you have to, but always take action. Even if you can only save a little bit each month, put that money to work for you. Begin looking for investments that you can afford and that you can understand. Do your homework and learn the details of each opportunity you come across. The more you understand, the better choices you will make. It is better to take a small step now than to wait for the perfect time, because waiting can hold you back forever. You must also surround yourself with people who know more than you. Seek out advisors, mentors, and professionals who can guide you. Pay them well for their advice because the right guidance can save you from costly mistakes. Spend time with people who are already successful in the areas where you want to grow. Watch how they think, how they make decisions, and how they find opportunities. By learning from their experience, you will shorten your own learning curve. Another action you can take is to give away what you want more of. If you want money, give money. If you want knowledge, share what you know with others. When you give, you create more room for growth in your own life. This may seem difficult at first, but it is an important step because it helps you build trust with others and open doors to new opportunities. Begin expanding your education. Read books, listen to audio programs, and attend seminars that teach you about money, investing, and building businesses. The more you learn, the better you will be at spotting good deals and avoiding bad ones. Make learning part of your daily routine so that you are always growing. Another thing you can do is to practice seeing opportunities with your own eyes. Spend time looking at properties if you are interested in real estate. Study the market and compare deals. If you want to invest in stocks, start following companies and learn how they operate. By paying attention and studying carefully, you will build the ability to know a good deal when you see one. Take time to work on your own business or side income. Even if you have a job, find ways to build your own asset column. This can be done through investments or by creating something that can generate income on its own. Always keep your focus on building assets that grow in value over time. Above all, act now. Do not wait for the right conditions because the perfect time may never come. Take one step today and then another tomorrow. Each action you take will move you closer to your goals. If you stay consistent, you will see progress and your confidence will grow. By following these actions and staying committed to your financial growth, you will be on the path to creating the life you want. The choice is yours to take control of your financial future and make it happen.
Hello and welcome. If you're passionate about mastering the markets and building true trading discipline, you're in the right place. Before we dive deep into this transformative journey through Come
I
Into My
think we're
Trading
still
Room
gonna
by
go
Dr.
below the
Alexander
open
Elder,
for sure.
make sure to like, share, and subscribe to our channel for more
Where else
powerful
on the looks
audiobook
like
summaries like this one. Now, take a deep breath. Imagine stepping into a quiet room. Not just any room,
we have
but the sacred
macro now.
workspace of a seasoned trader. The charts
The
glow,
previous
the
market.
journal lies open, and a calm, methodical mind is at work. This is more than a guide. It's an invitation. A mentor's hand reaching out to help you master your emotions, build your trading system, and protect your capital like a professional. In this audiobook, you'll learn not just how to trade, but how to think, act, and survive in the world of financial markets. Let's begin. Chapter 1. Invest, trade, gamble. There are three ways people try to make money in the market: investing, trading, and gambling. While they may seem similar from the outside, they are completely different in how they work and what they require. Understanding the differences between them is the first important step toward financial success. Investing is focused on the long term. It is about buying good quality assets like company shares or mutual funds and holding them for years. The goal is to benefit from the steady growth of the company and the overall economy. Investors do not check prices every day. Instead, they study a company's business, look at its earnings, and try to figure out if the price today is lower than what the company is truly worth. If it is, they buy and wait patiently. Time is their best friend. They trust that over time, value will rise. Investing does not promise fast money, but it builds wealth slowly and steadily. Trading, on the other hand, is much more active. It is about taking advantage of short-term price changes. A trader studies charts, price movements, and indicators. They look for patterns that can help them predict where the market might go next. Unlike investors, traders do not hold positions for years. Some may hold them for days or weeks, while others may enter and exit the same day. What separates a real trader from others is discipline. A good trader has clear rules for when to enter a trade, when to exit, and how much money to risk. A real trader does not chase prices or rely on feelings. Everything is planned. Every action is controlled. There are no random decisions. Then there is gambling. This is the dangerous side of the market. It happens when people enter without preparation, without knowledge, and without control. They buy or sell just because they feel like it or because someone on the internet told them to. They risk too much money. They hope to get rich quickly, and they often end up losing it all. Gambling is not only about betting on random trades. It's also when someone knows they should follow a rule, but breaks it anyway. For example, if they say they will never risk more than 2% of their money on a trade, but then suddenly risk 20% just because they feel lucky, that's gambling. Sometimes people think they are trading, but they are actually gambling. The difference lies in control. A trader respects the plan. A gambler ignores it. A trader knows when to stop. A gambler keeps chasing losses. The market is filled with people who start with hope, but lose everything because they don't know how to manage risk. They get pulled in by dreams of fast money, but they never take the time to learn. This is why it's important to understand that gambling is not just about luck. It's about lack of structure and control. The market does not care who wins or loses. It offers opportunities to everyone, but it rewards only those who treat it seriously. Many people come to the market hoping to turn a small amount of money into a fortune overnight. But the market has its own rules. It requires patience, skill, and self-control. Those who do not respect it often find themselves
Good.
trapped in a cycle of fear, greed, and regret. To succeed, one must decide what they want to be. If the goal is long-term growth, then investing is the way. If the goal is to earn from short-term movements, then trading must be approached with a solid method. But if the approach is careless and emotional, then it turns into gambling. That leads to losses and frustration. Success in the market comes only with preparation. It's not about choosing the right stock once or making one lucky trade. It's about having a repeatable process. Every time a decision is made, it must be part of a larger plan. Those who learn this early have a chance to grow and survive. Those who don't often burn out quickly. So, before taking the first step, it is important to ask a simple question. Is this a decision based on study and control, or is it just a guess? The answer can mean the difference between building wealth or losing everything. This is where the real journey begins. Chapter 2. What markets to trade? When starting a trading journey, one of the first and most important decisions is choosing which market to focus on. There are many types to consider, and each comes with its own nature, tools, and challenges. Some traders rush into the most talked about areas without fully understanding the rules and structure. But to trade successfully, it's important to study how each market works before putting money into it. The most common and accessible place to begin is the stock market. This is where many people start because of its stability and the large number of available companies. Stocks represent ownership in a company, and they move based on business performance, news, and market trends. Stock trading happens during specific hours, usually Monday through Friday. It is highly regulated, which adds a level of safety for beginners. It also offers tools like charts, earnings reports, and public data, making it easier to research trades. Stocks are often less volatile than other markets, which means price swings are usually smaller. This helps newer traders stay calm and gain experience without facing too much risk. Then there's the world of futures. These contracts represent the agreement to buy or sell a certain item, such as oil, gold, or agricultural products, at a future date. Futures are more complex. They involve much higher leverage, meaning that small price moves can create big gains or large losses. The futures market trades nearly 24 hours a day, and it requires a solid understanding of both risk control and the contract's behavior. Futures are better suited for traders who already understand price action and know how to protect their capital using proper rules. Another active space is the options market. This involves contracts that give the right, but not the obligation, to buy or sell something at a certain price within a certain time. Options trading is more advanced and needs strong math skills and deeper study. There are many ways to use them, such as protecting a stock position or betting on price moves. But options come with many terms: calls, puts, expiration, strike price, and they decay over time. If not used carefully, they can lead to losses even when the market moves as expected. For this reason, it's important to get comfortable with simpler instruments before exploring options. Currencies, or the forex market, is one of the largest markets in the world. It trades almost non-stop across all time zones. Currency pairs like euro to US dollar or US dollar to Japanese yen move quickly and can be affected by political events, interest rate changes, or central bank decisions. The forex market has low barriers to entry, which can make it attractive. But the fast pace and high leverage demand discipline and constant attention. Many new traders enter the space too early and make emotional decisions without a clear plan. Commodities such as gold, silver, oil, and agricultural products are traded both through futures contracts and exchange-traded funds. These markets often respond to world events, weather conditions, and supply-demand news. While the price action in commodities can offer great trading opportunities, they can also be heavily influenced by sudden global changes. This creates quick moves that can be dangerous without proper tools and planning. It's also important to understand the difference between markets with high liquidity and those with low volume. Liquidity means how easily a trader can enter and exit a position without large changes in price. Highly traded stocks and popular currency pairs have more volume, meaning smoother trades and less risk of getting stuck in a position. Illiquid markets, on the other hand, might show strong moves but can trap traders with wide spreads and poor fills. Choosing a liquid market helps reduce cost and improve results. Trading requires careful choice. It's not wise to jump from one market to another based on news or excitement. Focusing on one area helps build skill and understanding. Some traders find success with stocks, others with futures or currencies. What matters most is picking a market that suits your time, capital, and personality. Once chosen, that market becomes the place to learn, test, and grow. With time and consistent effort, a trader becomes familiar with its rhythm, structure, and signals. That deep connection is what helps bring clarity, confidence, and strong performance. Chapter 3: The First Steps. Starting a trading journey doesn't begin with buying or selling anything. It begins by accepting that trading is a profession, not a quick game. Many people rush into markets without preparation. They think reading a few articles or watching a few videos is enough. But real preparation requires more. First, you must treat trading as a business. That means planning, organizing, and learning just like any serious job. Before placing even one trade, you must make sure you have the right foundation. That starts with choosing a good broker. You need a broker who gives you solid execution, low fees, and a reliable platform. But don't rush. Take your time to compare services, check reviews, and understand all the fees involved. Hidden costs and poor execution can eat your profits before you even notice. You must also avoid dealing with salespeople who make big promises or push you to trade more. Next, you need to get the right tools. A strong charting platform is important because you will depend on technical analysis. Choose software that gives you good charts, indicators, and the ability to test different strategies. But don't chase fancy tools with features you don't understand. What you need is clear, simple, and reliable data. Along with that, set up your workspace. Make sure you have a calm place to think, analyze, and make decisions without distractions. If you take trading seriously, your environment should reflect that. One major step is creating a trading diary. This is not just a notebook. It is your personal record of every trade, every decision, and every mistake. You must write down what you bought or sold, why you did it, what your plan was, and what happened after. By writing down everything, you create a mirror. Over time, this mirror will show you your real habits, both good and bad. You will start to see where you make strong decisions and where you go off track. Without this kind of record, it's easy to repeat errors without knowing. Then comes the most important preparation: trading with fake money before risking real money. This is called paper trading. You don't use real funds, but you follow the market and place trades on paper as if they were real. This helps you test your method, understand the market, and get used to your tools. Many people skip this, thinking it's a waste of time. But this step helps you avoid expensive mistakes when you're finally using real money. After you're ready to trade with real money, you must control how much risk you take. There are two simple rules. First, never risk more than 2% of your account on one trade. This protects you from big losses. Even if a trade fails, it won't hurt your account badly. Second, never lose more than 6% of your account in a month. If you hit that limit, stop trading and review what's going wrong. These two rules are like a seatbelt. They keep you safe while you learn and improve. You also need to avoid common traps. Don't try to trade too many different stocks or markets at the same time. Focus on a few and understand them well. Don't try to get rich quickly by taking huge risks. That usually leads to big losses. And don't chase tips, rumors, or hot news. Instead, build a system based on real thinking and clear rules. At this stage, the biggest task is preparing your mind. You must learn to stay calm during wins and losses. Many people panic when they lose and get greedy when they win. That's when they make poor choices. You must act like a professional, making decisions based on logic, not emotion. This takes time, but it starts with these first steps. By setting up the right tools, building a clean record, using fake trading to practice, and following simple risk controls, you create a strong base for long-term success. This is how your trading journey truly begins: quietly, patiently, with focus and structure. And once this base is strong, you'll be ready to face the markets with skill, not guesswork. Chapter 4: Mind, the Disciplined Trader. The first step to becoming a successful trader is learning to see yourself clearly. Most people think they are logical and calm, but trading shows how quickly fear, greed, and excitement can take over. These emotions cloud your judgment and make you break your own rules. You might feel very sure about a trade 1 minute and then panic when the market moves against you. This is not a sign of weakness. It's human. But to trade well, you must rise above these emotions. A disciplined trader builds awareness. Before placing any trade, it is important to stop and ask, why am I taking this trade? Am I following a plan? Or am I chasing a feeling? Discipline starts with asking these simple questions. Without this habit, it's easy to act on impulse and call it confidence. Many people start trading because they want excitement or quick money. But this mindset leads to emotional trading. The goal must be different. You must think of trading like a professional does, with structure and calm. You need to act based on analysis, not feelings. If you let emotions lead, you will buy high when everyone else is excited and sell low when panic hits. This leads to losses and frustration. To train your mind, create a daily routine. Before the market opens, prepare a plan. After the market closes, review your trades. Write down what went right and what went wrong. If a trade made money but broke your rules, it was a bad trade. If a trade lost money but followed your rules, it was a good trade. This way, you separate your emotions from your process. This is how a disciplined mind grows stronger every day. Do not aim to win every trade. That's not possible. Even the best traders lose sometimes. The key is to stick to your plan no matter what. When you follow your system, you give yourself the best chance over time. If you change your method every time you lose, you will never get good at anything. A strong mind is steady. It does not jump from one thing to another. One way to stay calm is to limit how much you risk on each trade. If you risk only a small part of your account, you can think clearly. But if you risk too much, every move in the market feels personal. You will feel fear and pressure. That fear makes you exit trades too soon or hold on too long. By managing risk, you protect not only your money but also your focus. Trading is not about being right. It's about being smart with your actions. The market doesn't care about your opinion. It doesn't care if you worked hard on your analysis. If the trade goes against you, get out. Don't argue. Don't hope. Just follow your rules. This sounds simple, but it takes practice. You must teach yourself not to react emotionally when things don't go your way. Keep your ego in check. Many traders lose money because they want to prove they are right. But trading is not the place to win arguments. It is a place to follow signals and manage risk. A disciplined trader is humble. They know that their main job is to follow the process, not to be perfect. This mindset keeps you grounded, even when the market surprises you. Sometimes you will be tempted to break your rules, just this once. You might think, the setup is almost right, I'll just take it. This thinking is dangerous. The moment you break your own rule, you train your brain to do it again. Every rule you break weakens your trading mind. It is better to miss a trade than to make a habit of breaking rules. Keep track of your thoughts and actions in a trading journal. This is not just a place for numbers. Write about your feelings before and after trades. With time, you will see patterns. You might notice that you often enter trades too early or that you get nervous after a loss. These insights help you improve your behavior and stay on track. The disciplined trader treats trading like a business. There are rules, systems, and structure. There is no room for guessing or gambling. The focus is not on fast profits, but on steady growth. The real win is building a clear, calm mind that can act wisely even when the market gets noisy. And this is where the real journey begins, when the mind becomes your strongest trading tool. Chapter 5: Method, Technical Analysis. In trading, method is the tool you use to read the market and decide when to enter or exit. To build that method, it's important to understand the basics of technical analysis. Everything starts with the chart. A chart shows the price movements of a stock or market over time. There are different types of charts: line charts, bar charts, and candlestick charts. The most useful one is the candlestick chart because it gives more detail. Each candlestick shows the open, high, low, and close of a specific time period. By watching how these candlesticks form, you can get a better idea of market behavior. The next step is to understand trends. A trend is the direction in which prices are moving. If prices keep going higher over time, it's called an uptrend. If they keep going lower, it's a downtrend. When prices move sideways, it's a trading range. The key to reading a trend is to look at the sequence of highs and lows. In an uptrend, each high and low is higher than the one before. In a downtrend, each high and low is lower. If the highs and lows are about the same, the market is moving sideways. Support and resistance are important parts of trends. Support is the price level where buying is strong enough to stop a price from falling further. Resistance is where selling pressure stops a price from rising higher. These levels often repeat, so you can use them to plan your trades. If a price breaks through a support or resistance level, that's a sign the trend might continue in that direction. Moving averages are tools that smooth out price data so you can see the trend more clearly. A simple moving average takes the average price over a number of days. For example, a 22-day moving average shows the average price over the last 22 days. When prices are above the moving average, the market is usually strong. When they are below, the market is weak. One useful method is to compare a short-term average with a long-term one. If the short-term average is above the long-term, that's a bullish signal. If it's below, that's bearish. Indicators can help you understand when a market is strong or weak. One key indicator is MACD, which stands for Moving Average Convergence Divergence. This tool uses two moving averages to show the momentum of a trend. When the MACD line crosses above its signal line, it often means the market is going higher. When it crosses below, it could be turning lower. Another useful tool is an oscillator like the force index. It measures the power behind a price move by looking at price and volume together. A strong move backed by heavy volume shows real strength. A weak move on light volume shows little power. Oscillators are also good for spotting when a market is overbought or oversold. If an oscillator reaches extreme levels, the market might be due for a change in direction. Volume is the number of shares traded in a given period. High volume shows strong interest in a stock. If prices rise on high volume, the move is more likely to continue. If prices rise on low volume, the move may not last. Watching volume helps confirm whether a trend is real. Charts, indicators, and volume give you tools to study the market. But no single tool is enough by itself. It's better to use several tools together. For example, you might look for a trend using moving averages, confirm it with MACD, and check volume to see how strong it is. When multiple tools give the same signal, your chances of a good trade are better. It's also important to look at multiple time frames. If you're trading short-term, check the daily chart and the weekly chart. The weekly chart shows the bigger picture, while the daily chart shows the details. If both charts point in the same direction, that's a good sign. If they disagree, it's better to wait. The key to using technical tools is to stay consistent. Use the same tools in the same way every time. Keep track of your results and make small improvements. Over time, you'll learn what works best for you. The goal is to create a clear, repeatable method that fits your style and helps you trade with confidence. Chapter 6: Trading. In trading, the ability to follow a structured plan separates success from confusion. The process begins with preparation, studying market charts, selecting a group of instruments, and knowing exactly when to enter and exit a position. Each trade must be based on clear rules, not emotions. A trader must always know what to buy, when to buy it, where to place a stop, and when to take profits. These are not guesses. These are decisions backed by technical analysis, market timing, and risk control. A good trading system starts with identifying the trend. This is done using moving averages and price patterns on a higher time frame. The larger trend provides the overall direction. If the trend is up, only long trades are considered. If the trend is down, only short trades are taken. Going against the main trend is risky, so the first job is to understand the big picture. Once the direction is known, the focus shifts to finding entry points on a smaller time frame. This process is called the triple screen method. The first screen is the longer time frame, which shows the main trend. The second screen is the intermediate time frame, where momentum indicators like the force index or MACD help spot pullbacks and opportunities to enter. The third screen gives the exact entry using a technique like a trailing stop or a breakout strategy. This system filters out bad trades and keeps the trader in line with the trend. When a trade setup appears, the position size must be calculated carefully. The risk per trade should never be more than 2% of total capital. This means even if the trade goes wrong, the account remains safe. A stop loss is placed right after the trade is entered. This stop is not moved unless the trade is going in the right direction. Moving stops too early often leads to missing good trades. But not having a stop is worse. It turns a small mistake into a large loss. A trader must also decide when to take profits. There are two ways to do this: set a target and exit once it is reached, or trail a stop and let the market decide how far it will go. Both methods work, but they must be used with discipline. Never let a winning trade turn into a losing one. At the same time, don't cut profits too early out of fear. The key is to follow the plan without second-guessing. Keeping records is as important as making trades. Every trade must be written down in a journal. This includes the date, the instrument, entry price, exit price, stop-loss level, reason for entering, and outcome. Reviewing the journal helps find mistakes and improve the system. Patterns appear over time, showing what works and what needs to change. It becomes clear if entries are rushed, stops are too tight, or profits are cut too early. Improvement only happens when facts are studied, not feelings. Market conditions change, and no system works all the time. A trader must stay flexible but never abandon discipline. If the market is quiet or shows no clear trend, it's better to stay out. Trading in unclear conditions leads to mistakes. Patience is a part of the process. Waiting for the right setup is often more profitable than trying to trade every move. Trading is a serious business. It requires planning, execution, and constant review. There are no shortcuts. Each trade is like a small part of a larger strategy. It must be managed with care. With a clear method, strict money control, and careful records, anyone can improve over time. Success is not built on luck or big wins. It is built on steady steps, careful choices, and full focus on process. When this process is followed with consistency, trading becomes a powerful and rewarding profession. Chapter 7: Money Management Formulas. In trading, protecting your money is just as important as finding winning trades. Managing risk is the shield that keeps a trader alive when the market becomes uncertain. One of the most important rules is the idea that no single trade should ever have the power to destroy your trading account. To keep your capital safe, there is a simple rule: never risk more than 2% of your account on any one trade. This 2% rule means that even if you have a losing trade, it will not cause serious damage to your overall balance. To follow this rule properly, you first need to understand how to calculate the amount you can risk. This is done by using the size of your account and measuring how much you're willing to lose on a trade. For example, if your account has $10,000, then 2% of it is $200. This means you should not lose more than $200 on any trade. The stop loss should be placed in a position where the loss would not go beyond that limit. There is also another important rule known as the 6% rule. This rule protects your trading account from a series of losses. It says that if your account suffers total losses adding up to 6% of your total capital in a single month, you should stop trading. You take a break, review your trades, check your strategy, and return only when you are ready. This rule helps you avoid the damage caused by emotional trading and overconfidence. When calculating how many shares or contracts to buy, the trader must consider both the size of their account and the distance between the entry price and the stop-loss level. This difference, called the risk per share, allows the trader to find how many shares to trade. For example, if you're willing to lose $200 and the risk per share is $2, then you can trade 100 shares. If the risk per share is $5, then you can trade only 40 shares. This way, you stay within the 2% limit no matter what you trade. The goal is to treat your capital like a submarine with many watertight rooms. If one room is damaged, the entire ship does not sink. Every trade is like one room. If a trade fails, the damage is contained. This thinking helps traders survive in rough markets and remain in the game long enough to reach success. Position sizing plays a huge part in managing money. A small